Despite risk of near-term volatility, investors should focus on the favorable longer-term outlook. After a sharp rally since last November, we see signs that the market looks stretched over the near term. Although this means that the risk of a pullback is higher than usual, we believe investors should stay invested and focus on the bigger picture. The longer-term setup for equities underpinned by easing monetary policy direction and financial conditions, continued disinflation, and limited hard landing risk appears favorable. We highlight that the US Federal Reserve conveyed important dovish signals for markets at its latest FOMC meeting. In addition to affirming expectations of 3 cuts this year, Chairman Powell also signaled that the Fed is likely to taper the pace of its quantitative tightening program fairly soon. Together, these shifts reflect a more accommodative monetary policy stance, which will continue to set off reflationary tailwinds for risk assets. Thus, we continue to see a base case scenario of 3 rate cuts this year starting from June and maintain an overall risk-on position in our tactical asset allocation. This month, we upgraded our position in emerging markets high-yield bonds from neutral to overweight, given declining hard landing risk, undemanding valuations, and attractive carry providing scope for further spread compression. We are also downgrading our position in emerging market investment-grade bonds from neutral to underweight. Now, this credit asset class appears relatively unattractive given tighter spreads since 2007, offering only limited incremental pickup versus developed markets. In equities, we continue to hold an overall overweight stance via an overweight position in Japan and neutral positions in US, Europe, and Asia ex-Japan. In terms of stock selection, investors could also look into opportunities outside of US big tech, given that the maturing rally is likely to broaden into the rest of the tech sector and other parts of the market, especially quality companies in healthcare, consumer staples, and the utilities sector. I am Eli Lee, and this is Bank of Singapore Research.
For more information, please refer to this month's monthly investment guide.